Bond yields across the world are soaring high. So does it mean anything? What does it mean? Does it mean optimism, a booming global economy, or does it mean that clouds of recession are approaching? To answer this very important question, let's first start with the basics. Now, the bond market simply refers to the marketplace where investors buy debt securities of either government or private corporations or companies. But do you know how big is the bond market? As per Securities Industry and Financial Markets Association 2021 report, the global bond market was valued at around $119 trillion. Now, this figure is much bigger than the GDP of all the countries in the world put together, which is estimated to be around $100 trillion. Moreover, around 39% of this humongous bond market is comprised of the US fixed income market. Therefore, any change in the bond market in the US impacts the whole world, not only the bond markets but also the equity or stock markets as well. Now, as often the funds keep on fluctuating between bond and equity, especially in the case of institutional investors. Right now, bond markets are going through an unusual phase. On the 23rd of September 2022, the 2-year Treasury yield scaled to 4.266%, reaching a 15-year high, while the long-term benchmark, the 10-year Treasury, hit about 3.829%, which is the highest in 11 years. Now, a bond yield is the return that an investor will get for purchasing the bond. Therefore, higher yield naturally means that the investor will get larger interest payments, but it is also a sign of greater risk. Now, currently, it's important to understand that the yield of shorter-term government bonds is higher than long-term bonds, which means we are now witnessing a yield curve inversion. Now, the yield curve inversion indicates that investors are moving money away from short-term bonds to long-term ones. This inversion suggests that the market as a whole is becoming more pessimistic or gloomy about the near future. The possibility of central banks tightening their monetary policy further to tackle the soaring inflation is making the investors see higher risk, as it could possibly lead to a recession or a downturn in the near future. Moreover, higher bond yield is also creating more competition for funds that may have otherwise gone to the stock or equity markets. Now, if we look at the US equity benchmark, that's the Dow Jones Industrial Average, it has almost lost all of its post-COVID gains. While in the Indian context, with rising bond yield, the incentive for FIIs to own Indian stocks is also being eroded. Now, with earnings season round the corner, it's going to be interesting to see how this global economic paradigm and the fear of looming recession will impact the performance of companies across the spectrum. For more on this, stay tuned to ET Now Web Originals.